1 month ago, we discussed the most important question in finance today, namely whether in the aftermath of the COVID pandemic the world ends up with runaway inflation or price-crushing deflation. Today, Bank of America provides some additional perspective on what it calls the inflation rollercoaster. Separating the inflation stories. As Bank of America notes, the pandemic has created significant disinflationary shock to the U.S. economy, with the latest CPI report showing core inflation running at a meager 1.2% YI clip and core PCE later this month likely to come in at 1.1%. That said, it is important to note that current inflation readings are suggesting conditions are much worse than they actually are. Indeed, most of the deceleration can be attributed to a handful of idiosyncratic components. The underlying trend is stickier and has slowed more modestly. Looking ahead, the underlying trend slows with rental inflation holding the key. This means that the roller coaster will eventually turn. The base effects will turn positive in March 2021 and accelerate before settling at a higher, although still likely below target. Consistent with this thinking, Bank of America expects core CPI to trough at 0.8% YI in 1Q 2021 before rising to 1.6% by the end of next year. 4 Horsemen of Disinflation. From March through May, the months when the COVID shutdowns unleashed unprecedented damage on the U.S. economy, core CPI declined by a cumulative 0.6%, resulting in the percent YI rate collapsing to 1.2% from 2.4% in February. The deterioration owed largely to 4 main areas of weakness: lodging away from home, airline fares, apparel, and motor vehicle insurance. Despite these categories amounting to 6% to 7% of CPI, each experienced a record drop in prices. The first 3 fell as non-essential travel and businesses activity were shut down, and followed the same pattern of April being the worst month, followed by March and then May. Motor vehicle insurance dropped after insurers began an assortment of COVID-19 relief programs that provided temporary discounts or credits on auto premiums, for April and May for the most part. According to Bank of America, these components have added significant noise to the data and should be largely faded when thinking about the underlying inflation trend. They are extreme idiosyncratic moves and are likely to prove transitory, unless there is a second wave of shutdowns, of course. Moreover, we have already started to see stabilization in June as all 4 components posted an increase. With prices so low still, further positive payback seems more likely going forward than another major leg down. If excluded from core CPI, then inflation has slowed more modestly through June to 2.42% from a February reading of 2.59%. Another more standard inflation metric that paints a similar picture of stickier underlying inflation is the Cleveland Fed's trimmed mean CPI, an index that excludes the 8% of components with the most extreme moves to the upside and the 8% to the downside. Trademark CPI has also seen modest slowing to 2.27% YI from 2.42% in February. But the risks are skewed to the downside going forward. Given the stickiness of underlying inflation, it takes some time for the demand shock to percolate and pull down prices. The coming rent pocalypse. The key for underlying inflation will be what happens to owner's equivalent rent, OER, and rent of primary residence, since the two comprise more than 40% of core CPI inflation. The housing data have been particularly resilient relative to the broader economic data, with the NOB Housing Index just recently popping up to 72 in July from 58 and existing and new home sales likely to rise in June. Indeed, home viewing demand has been surprisingly firm during the pandemic as lower interest rates have raised affordability and preferences have increasingly shifted towards suburban living where home ownership is more feasible. However, the resilience of the home ownership market is likely to come at the expense of the rental market. While owner's equivalent rent is meant to reflect housing costs borne by owner-occupied households, it is estimated using rent data and will therefore be sensitive to rental market dynamics. So where do rents go from here? According to Bank of America, the labor market conditions will be a major driver of the rent trajectory. The early data have surprised expectations, with the unemployment rate peaking at only 14.7% in April and falling to 11.1% in June. However, job gains going forward will not be quite so easy to come by. The virus is not under control, as several hotspots have emerged in the last month, and most states have either put a pause on or reversed the reopening process. The real-time labor data are ominous, as well as the Census Bureau's Household Pulse survey have shown declining employment since the week of June 16. Meanwhile, Bank of America notes that it has started to see weakness register in CPI in the latest June report. Both owners' equivalent rent and rent of primary residence increased by only 0.1%, the softest readings since early 2011. This resulted in the percent YI rates for OR falling to 2.8% YI from 3.3% in February, and for rent of primary residence to 3.2% YI from 3.8%. And while it may be premature to read into 1 month of data, Bank of America's economists believe that this could be the beginning of a downtrend. The regional OR data reveal that the soft June data were largely driven by the South and West. Weakness was also relatively broad in these two regions, as rent inflation in both large, A, 2.5 MN people, and small, BC, 2.5 MN people, urban areas were 0 to 0.1%. Meanwhile, the Northeast and Midwest posted trend-like rent gains in June. These two regions have not been immune to the deterioration in labor conditions, so that does pose a bit of a disconnect in terms of the labor rent response. The June print would be more convincing if all four regions had softened. Should this happen, clearly there is scope for even weaker monthly readings in broad OR and rent of primary residence. Even if June ends up being slightly fluky, the risks ahead are clearly skewed to the downside. It is worth reiterating that the CPI methodology allows for significant deflation to materialize in the rent components. If there is a missed payment and the landlord does not expect or is uncertain they will receive it, then that will register as a 95% decline in rents. Therefore, even a small share of missed rent payments can exert a noticeable drag. This is a tail risk, though. Jansen and Verbrugge, July 2020, found that the incidence of non-payment in the CPI sample was quite low during the Great Recession. However, given the speed and severity of the current downturn, it could prove to be different this time. What will slowing rents mean for underlying inflation? We can proxy the impact by simulating the effects of rent on core CPI. If OR and rents average a 0.15% clip from now until the end of 2021, then core CPI percent YI would slow by roughly 0.5 pp. If a softer average 0.1% reading, then it would be a 0.7 pp deceleration. Bank of America believes the underlying trend could slow by an amount within this range, although they can't eliminate the risk of an even worse outcome, as labor market slack will remain elevated, with the unemployment rate ending next year close to 8%. Stuck in purgatory. Putting it all together, Bank of America expects core CPI to continue to be biased lower through the early next year, with core CPI settling below the pre-COVID trend 1.6%. After this point, the special factors will start to fade, allowing for acceleration.